Good evening, everyone. This is your tutor Mia Saad Muhammad for Practice to Pass webinar for the Advanced Taxation exam. I welcome you all on behalf of ACCA. Can all of you please raise your hands if you can see my screen and hear me clearly? Thank you. I can see many students who were present yesterday as well. Thanks for rejoining. Okay, guys, with starting with my quick introduction, my name is Mia Saad Muhammad. I've been teaching this subject since 5 years, and I teach at one of the gold approved learning partners, LGS Defense International Degree Program. And apart from teaching, I manage my own consultancy called MNSK Chartered Accountants. So, as in all of my sessions, I have emphasized that this paper is about tax planning, and if you want to score well and achieve a pass grade in that, you should learn as to what tax planning is and how to convey it to the examiner in your paper. So I have carefully selected bunch of questions today as well that not only covers few topics which student usually find troublesome, and but they are also important from the exams point of view as well. So let's quickly discuss that. What is the schedule of today? So guys, for day 3 we have one question called D, that is from September 18 attempt. Then we have Plot Limited and Quill Limited, that is from March to June 19. And then we have Dent Limited, that is from March to 19. All of these questions can be found from Kaplan's Revocate, but they can also be found on ACCA's practice platform, CBE practice platform. And in my previous sessions, I have emphasized that you should use that because now the exams are computer based and you should get yourself familiarized with the outlay and the functionality of the computer based platform. Now, moving on to the questions. Uh, for the students who have joined today, if you have any sort of questions, please post your questions in the question section. Shabina has asked me, sir, that do I have the answers available for the questions in my or the examples in my notes? Sorry, Shabina, I usually solve them myself in the class with the students. I don't have the solutions in the printed form, otherwise I could have shared. So apologies for that. Any more questions, guys? You can post into the question section. I'll try to answer in between. Now, so I will start with Plat Limited and Quill Limited. So I'll take you to the ACCA's practice platform, CBE practice platform, and there, this question is question number 2 in ACCA's practice exam 3. If any of you is unsure as to how to access this practice platform, please do refer my day 1 session in which I have taken all of the students through the complete process as to how you have to log in and how you can use these exams. Now, as I have mentioned and taught you guys that the best way to start question is to read the requirements, but you can see here that it is a 25 mark question, which means that this question is from section A. Let me quickly repeat the paper pattern here, that section A will consist two case study questions. One is for 35 mark, one is for 25 mark, and section B will consist of two 20 mark question. In our day 1 and day 2 of the Practice to Pass webinar, I have solved the question with you, majority of them which were 20 marks. So it is probably the first 25 mark question I am going through with you. So I will also share the key differences normally there are in the requirements and the topics being tested. However, there is a fact that I have mentioned that the examiner has clearly mentioned that there will be 5 marks on ethics in section A, which can either be tested in question number 1 or question 2. And there'll be 4 professional marks, which will be part of question number 1 only. They will not be part of question number 2. Now, there were a few students in the yesterday's lecture and day before yesterday, that sir, as to how we can prepare for ethics. So here is the question which involves a part of the ethics. As usual, we will go through the notes as well, and we will study the topics that have been tested. Now, let's read the requirement. Now, one of the key differences of 25 mark question from the 20 marks question, that there, whenever you click on their requirements are merely marking scheme. They will not tell you anything, or no elaboration will be available to get an idea as to what will be tested in that. So do remember that is a difference, that in section A, the requirement A or the question is usually split into three parts. One will be the scenario, second will be the email or extract from the email, and third will be requirement. In the requirement, you'll merely find the marking scheme. In the extract from email, you will then find the detailed requirements. I will also tell you as to how to use the extract to make sure that you have answered every bit that has been asked by the examiner. Because I've told you in the very first day that one of the key reason of failing in ATX exam is that you do not answer all parts of the requirement. I mean, you think that you have answered all parts, however, that is not the actual case. So, what is the expectation gap between you and the examiner? We'll be discussing that today as well. So it's merely a marking scheme. That part is for 18 marks, which has some sort of group relief. Obviously, the group relief is the topic of corporation tax, group registration for value added purposes. Uh, the group registration for VAT is a topic of value added tax, but in my notes, you will find it in corporation tax chapter. And then it's PLAD limited unreported chargeable gain. Normally, anything unreported, undisclosed is a hint that this part relates to the ethics, and its marks are telling me this same story as well. Because the ethics marks will be 5. They will not be less than 5, they will not be more than 5. So they will be 5 marks for ethics. So I can tell that this part is for ethics. However, if I want to read the requirement in detail, I have to click on the extract. This will provide the elaboration or the more detailed requirements. As we see that requirement A is quite lengthy, whereas requirement B and C are quite short. So here I want to share a time saving technique with you, that normally what happens is that the examiner has clearly made headings in the scenario as to which paragraph relates to which requirement. So if you read requirement in isolation, it will not make that much of a difference. For example, you can do that, especially for the part of ethics, that you can read the requirement of that part, and then in the scenario locate the paragraph that relates to that, and skip the or skim the remaining question and read that part directly, and just make an idea that what will be your answer. Then start reading the question, the full question, and if there is anything else that you find in remaining question that relates to that part, you can note it somewhere. But that is usually not the case. I mean, I have tried so many questions, but normally the requirement that relates to ethics is normally available in the ethics paragraph in the scenario. So let's read the shorter requirements first. So I will start with B first. Explain any additional matters of which Claire should be aware in relation to group registration for VAT purposes. At this point, I don't know who Claire is. However, he needs some knowledge about group VAT registration purposes. All I know is that if you have a company that are either owned by same individual or they are under common control, they can form a VAT group. And what is the benefit of VAT group? The benefit is that all of the companies can submit their VAT returns together, but they should nominate a company who will be responsible for the communication for VAT purposes with HMRC. Another feature or the another benefit is that the company do not have to charge VAT intra-group, means they do not have to charge VAT on sales or claim input VAT on purchases that they make in between themselves. For example, if company A has sold something to company B and they are the member of VAT group, they do not have to charge output or input VAT on that. So and then only one VAT return should be submitted. So it also provides us the administrative and cost savings as well. So these are some benefits that are in my mind, but I will read the scenario and look that what are the matters that Claire is already aware of, and what are the matters that I have to explain it to him. Then part C, Plot Limited unreported chargeable gain. Explain the implications of Plot Limited and for our firm of the failure to report the chargeable gain to HMRC. You should not address money laundering or the possibilities of penalty, as I have already spoken clear about these matters. Normally, what happens is whenever a client is hiding something from HMRC, we tell in our answer that if you do not report, HMRC may categorize it as a money laundering, which is a criminal offense itself, and can charge you severe penalties. However, there we will skip this line. Why? Because the manager has stated that he has already spoken to him and told him about the money laundering and penalties. So we'll skip that line. Otherwise, this is a standard line that I always use in my answers of ethics question. So before I move on, I'll take you to my notes first. In the income tax, I have dedicated a separate section for ethics. At the very end of the chapter, you will find that. And here I have made a chart, which is also available in the Kaplan study text as well, that tells you the possibility of the topics on which the ATX examiner can set question. And the good thing about his ethics is that the parts are of repetitive nature. And in every attempt or in every 35 or 25 mark question, not sorry, every attempt, I should rather say, because examiners sometimes test the ethics with question 1 and sometimes with question 2. So you never know if you're attending a 25 mark question from a kid and it does not include ethics part. Do remember that in that year the examiner might have tested it in the question number 1, that is the 35 mark question, but every exam has the ethics part. So in KIT or in past papers, you will find several questions. And if you do like 4 5 questions, you realize after 4 5 questions that they are of repetitive nature. The wording of the answer is similar, the type of question is similar, and what is that? So that is why I have categorized the major types. One is regarding the new clients, one is regarding conflict of interest, one is regarding HMRC errors, or it can be either on tax evasion or avoidance or money laundering. But I'm pretty sure that it's not on money laundering here. Why? Because the manager has already told. Now, the first is prospective clients or new clients. In that, normally the questions ask you that what are the procedures that we as a tax advisor or a tax consultancy company or firm should perform before taking this as a client. Okay, so these are the lists that you must learn, that we must obtain the evidence of client's identity. Okay, then we need proof of address. Then we need proof of incorporation if if it is a company. Then details of the directors or shareholders or whoever are the owners or beneficiaries of the business. These are the documents that we require. Moreover, we have to make sure that by accepting this engagement, it will not pose any threat to our ethical stances. Now, ethical principles you have well read in your papers, especially audit exam, and same ethical principle will apply here. Same objectivity, integrity principle, and professional competence and due care. Now, then there is conflict of interest, that we might be acting for one company and we at the same time we are acting for their competitors or their partners, so that it might create a conflict of interest. So we have to make sure, for example, before signing with other party, we have to seek permission, we have to inform both parties, things like that. You can find the complete list in the notes. Then it's HMRC's errors or tax regularity. Obviously the errors can occur from HMRC side or from your side. The point is that if you came across that either the HMRC has made any mistake, for example, HMRC has to process hundreds and thousands of returns, refunds, and tax payments. So what happens is, normally, for example, if HMRC was to refund someone 694, they have accidentally have refunded him 649, the lesser amount, or it can be vice versa, that they might have refunded higher amount. Now, this is sort of a mistake that HMRC has made unintentionally, obviously. Now, what's your responsibility as a tax advisor, and what's the responsibility of your client? Client's responsibility is that if he has identified that either he or HMRC has made any mistake, he or she should immediately notify HMRC and tell them regarding the mistake. However, if they are reluctant to do so, you as a tax advisor should encourage them to make the disclosure or to inform the HMRC. If they agree, well and good. But if they don't, you should tell them the consequences, for example, the type of penalties HMRC may impose or the other punishment. If they still don't agree, you are not allowed to retain such non-ethical clients. So you should, stop acting for the client, and you should inform HMRC that you have stopped acting for the client. However, do remember, you cannot disclose the reason to HMRC as to why you have stopped acting for the client. You can just mention them that, look, I have stopped acting as a tax advisor for this company. However, you are not allowed to disclose the reason to HMRC directly, because it will breach the principle of confidentiality. Now, this is a pet line that you will read in every second answer of the ethical question, that if the client disagrees, we will stop acting for them as a tax agent and we will inform the HMRC. However, we are not allowed to inform HMRC about the reason. So this line you will find at the end of every answer. So you have to learn this line by heart if the question is on HMRC errors and tax irregularities, which it normally is. The same is the case with tax avoidance and evasion. Same processes. If your client is involved in tax avoidance and evasion, you should uh, tell him or encourage him to tell HMRC or notify HMRC voluntarily. If he disagree, then you will obviously tell him the penalties. If he still disagree, then you will stop acting for him and inform HMRC without disclosing the reason. Then there are regulations regarding money laundering, that there should be one MLRO in our firm and we should avoid tipping off. Then there's a topic called GAAR. GAAR was introduced in your syllabus 2 years back, and HMRC has came up with that there might be a loophole, or there might be a technique or a trick that one may use to take the advantage more than he was normally entitled to. So if HMRC will came across identifying any such practice that the person has tricked HMRC and taken more advantage than he was supposed to by using some of the loopholes in the law, they will consider it as GAAR, General Anti-Abusive Arrangement or Rule. And what they will do is they will identify that what was the advantage you should received in the absence of the trick, and any other advantage or any excess advantage you have obtained, you not only have to pay that advantage back to HMRC, but they will also conduct the or they impose the severe penalties. Now, dishonest conduct of tax agent. What if we have conducted any dishonesty? Now, HMRC may impose civil penalty up to 50,000. There is no fixed amount. HMRC will decide case to case. However, the maximum is 50,000. However, HMRC normally, do not however, if HMRC poses a penalty which exceeds 5,000, the law gives permission to HMRC not only to penalize that tax agent but also to publish the details of that tax agent or company within the newspaper or other forms of communication or forms of media. So this is what the ethics part was, and by reading this and by reading the answers of the ethical parts, I am pretty sure that you will not you will not struggle to obtain very good marks in this part of the syllabus. Now we'll go back to the question and see that what type of topic has been tested there, and then I will discuss the answer with you. Explain the implications for P Limited and for our firm of the failure to report the chargeable gain to HMRC. You should not address money laundering or the possibility of penalties, as I have already spoken to clear. Now, guys, we know that there is some unreported chargeable gain that they must have, informed HMRC, but they haven't informed. So I have told you the complete procedure that you should encourage them that they should inform HMRC, and if they're not, then obviously you will tell them the penalties. If still not, you will stop acting. So this is the complete process. However, in order to quickly answer, what you can do is you can open the scenario, look for the paragraphs. For example, this is the paragraph that tells about unreported chargeable gain, and this is the paragraph that tells about value added tax. And you can quickly think about the answer of these two parts. Now, guys, out of 25 marks, these two parts are worth of 7 marks. So if I will be in your position, I will first try to secure these 7 marks first before reading the lengthy scenario. So let's quickly read this first. I have just discovered that the chargeable gain of 21,600 realized by P Limited in the year ended 30th June 2017 was omitted from its corporation tax return. So they have omitted this gain. They might not have omitted it deliberately, they might have omitted it mistakenly. However, whichever is the case, they should inform HMRC as soon as they can. Now, however, because the gain arose in respect of the land, it was reported for stamp duty land tax. Accordingly, the client is saying that they assume they do not need to report anything to HMRC. The HMRC will contact about this at some point, which is wrong. They should not wait for HMRC to contact them. Rather, they should disclose it to HMRC themselves. And rest of the steps I have told you, which you will be including in your answer. So with this, you have secured 5 marks out of 25 at least, and then let's move on to the VAT part. I would like the two companies to register as a VAT group for VAT purposes, whichever two companies these are, to avoid the need to charge VAT on intra-group sales. So I will skip intra-group sales point as an advantage. Why? Because the client already knows that, and generally reduce administration, and for the group to continue to use the annual accounting scheme currently used by Plaid Limited. Now he knows majority of the advantages, so I should ignore these. Rather, I should think about what are the other advantages that he can claim. So I appreciate this would mean that the two companies would be clearly and severely liable of the VAT group. Now, guys, what is your suggestion? What we should then tell him if he knows mostly all of the details? Any suggestion in the question section? Now, guys, what we can tell him is that the criteria of value VAT group, that is, the company should either be in the common control under one company, or the company can be owned by same individual. If that is the case, they can form the group, right? So this will be the only point that I will tell him, because he knows other things, and for 2 marks only, this is ample to score full marks. You can find the VAT group in my notes as well as a topic in corporation tax. Now, let's move on to the extract of email and let's read the first requirement. Do remember that we may not be able to understand it completely because we haven't read the scenario. Then there will be some students that may ask me, sir, if you have, preferred to read the smaller parts first, when starting the answer, or when we have will be answering the question, will you prefer to answer these parts first, or will you prefer to answer the question in order? Guys, for me, I will prefer that for the peace of mind while reading, think the answer of smaller parts first. Why? Because it takes off a lot of burden, that to pass the question out of 25 marks, you need almost 12.5 marks to 13 marks. Now, if you have secured 7 marks by reading the first, small parts, uh, me as a student will be quite relaxed that I only have to achieve 5 to 6 marks from part A, minimum, in order to achieve a pass grade. However, what it will do is that if I have this ease of mind that I do not have to obtain that many marks, even if the part A is difficult, I will still be relaxed that I do not have to score very much high marks in part A in order to pass the question. So key is to keep yourself relaxed, and these are the tricks to keep yourself relaxed, that you know that to pass the question you need 13 marks. So try to earn easy marks first, and then see how much short are you, and how much marks you still need to score to achieve a pass grade from the difficult or the lengthier parts of the question. That will be my approach, but this is for the reading perspective. However, when you'll be answering the question in writing, then try to answer them in order, because it will create the life of examiner or the marker easier, and obviously he will reward you as well in the form of lenient marking maybe. So that is why. Now, if any questions till now, guys, you can post in the question section, and I'll try to answer that. Yusuf, that is what you have to. Yusuf said that, sir, if we start the paths that are lengthier, we may not find time to, uh, solve the paths that are easier or smaller in length. Yusuf, when you will read the complete question, you'll have an idea as to how much you know regarding the lengthier part. So when you have the complete idea, you will obviously not spend that much time knowing that, even if by spending more time on this difficult part, you may not be able to score a high amount of marks. So why spend or waste time on this part? Rather, leave this part as it is, and then firstly complete the easier parts. This is only if you're in such scenario. So I have told you that there cannot be one single problem or one single policy. You have to play smartly in the exam and judge the situation and play accordingly. So please don't ask me, sir, what is your preference? What should be the game plan? There is no one game plan. You have to assess the question, situation, your knowledge, exam environment, and have to decide accordingly. I can tell you the tips on the basis of which you should decide. Now, let's move on to the bigger part, group relief. In order to help player make a decision, the ownership of Quill Limited, okay, he might be deciding to buy this company, she might be deciding to buy this company. Advise her of the tax advantage of Q Limited being wholly owned subsidiary of P Limited. So I have to advise him that what will be the advantage of P Limited being a wholly subsidiary of Q Limited. One very quick advantage that quickly came into my mind, that obviously two company will form a 75% loss relief group. And what is the benefit of forming 75% loss relief group? All of the losses of the companies, be it trading losses, be it property losses or interest deficit or any other type of losses, they can share their losses with each other. So this is the one most. However, if the companies are owned by a single individual, but they are not owned by each other, they will not be able to form the 75% loss relief group. Now, you should carry out this work in 3 stages. So examiner has told me that I should carry out this work in 3 stages. So do remember, in my answer, I will try to give 3 headings, and under each heading, I will try to explain or calculate whatever I can up to best of my abilities. Now, explain with supporting calculation. Again, you can see the frustration of examiner here, that he needs calculations as well as explanation. The maximum amount of group relief which P Limited would need to receive for the year ending 30th June 2022 first. That's fine. Such that none of its double tax relief in respective of the chicken tax would be wasted and its UK tax would be nil. So I hope that company might be operating somewhere else outside the UK, and the profits are being taxed there as well. And if you have a company or a subsidiary or an establishment that is situated outside the UK, and the UK government does not have the double taxation treaty with that country, what happens is you will be taxed twice. Now, firstly in the country in which you're earning the profits, and then in UK. So if there is no double taxation treaty, obviously you'll be taxed twice. So HMRC will provide you the double taxation relief. If there is a tax treaty, then only you will be twice once. Depends upon the treaty, that which country will charge the tax. But obviously, if the charge is being taxed once, there will be no double taxation relief. So double taxation relief is only available when the UK does not have the double taxation treaty with that country in which your company is operating. Okay, you should assume the rate of CT is 19% for all accounting periods. Then second requirement is prepare the calculations of CT liabilities of the two companies for the 2 years for 30th June 2023. So I have to calculate the CT liabilities, if there will be any, of companies for 30th June 2023. And in first part, I have to tell the group maximum group relief for this year. Your calculations should be on the basis that the trading loss of Q Limited will be used as soon as possible. List restricting the amount of group relief in an accounting period to maximum figure. Guys, whenever the client demands in the question that my loss relief should be relieved as soon as possible, the options that should come into your mind firstly should be set off against total income this year, or if there is a group relief available, try to give your loss to some other company. If the carry back option is available, carry back. Carry forward should be your last priority. Why? Because for carry forward you have to wait, and your client is requiring that he needs the loss to be relieved as soon as possible. But obviously, if other options are not available and carry forward is the only way, then after relieving maximum loss as soon as possible, the remaining loss you will mention in the question can only be carry forward. Now, third part, conclude by explaining that tax advantage of Q Limited become a wholly owned subsidiary as opposed to being owned personally by Claire. So guys, I will try to obtain these easy marks first, even if I do not have the clue of what is being asked in the first two parts. I can easily take marks by concluding that if Q Limited will become the wholly owned subsidiary of P Limited, they can make the 75% loss relief group, with the help of which they will be able to share the losses. They can also make a 75% gain group with which they can share their gains, and this relief will not be available if the companies will be owned personally by Claire. So always look for the easy marks. Now I will, being a student, I will be satisfying myself. Okay, I know the answers to part B and C, and I know something that is very easy in part A as well. So let's see what is the best I can do in part A in the remaining parts. When carrying out this work, you should be aware of the following: that in the year 30th June 2022, whole of the AIA will be available to Q Limited, and Q Limited will claim the maximum allowances available. Neither of the two companies will be required to pay CT in quarterly installments. This will be true regardless of who owns Q Limited. Guys, the companies that pay CT in installments are the companies who have turnover above 1.5 million. So, but this has already mentioned in the question that I do not have to consider this. The remaining every company that earns below that limit needs to pay their corporation tax in 9 months and 1 day after the end of the accounting period. Now, let's move on to the scenario and we'll try to relate the requirements as much as we can. Before I move on to the question, is there any question I can help you with? If there is any, please post your questions in the question section. Etisham, I didn't understand your question. What do you mean by do I have the question of 30 marks? If you're asking that, will we be solving any 35-mark question in this session? The answer is yes. Most probably be tomorrow. Otherwise, in the day 5, definitely will be solving 35-mark questions. Okay, moving back, let's start reading the scenario. I have owned the whole of the ordinary share capital of P Limited since 2006. P Limited trades mainly in the UK and is a UK resident company. It purchases components from the third parties to be assembled into finished products. It has also a permanent establishment in the country of Czechia. The profits realized in Czechia are subject to 14% Czechian business tax. There is no double taxation treaty. Obviously, that is why the DTR will be available. The budgeted taxable profits of P Limited for the year ending 30th June 2022 are set out below. P Limited's profitability is very stable, so please assume that the figures for the following year will be the same. Okay, that's fine. Trading profit is 48,000 and the trading profit that the company has earned before the deduction of 14% is 7,000. Now do remember guys, the total profits of the P Limited is 55,000 for this year. As per the requirement, what I remember is I first have to calculate that Q Limited is all obviously as per the requirement. I have an idea that it will be in loss. So I have to calculate that what is the amount of loss that Q can surrender to P for this year. What is the maximum amount of loss that can be deducted from 55,000, leaving that the DTR, the double taxation relief, does not go wasted. So we will come to that part and I will teach you a small trick as to how to calculate these figures if you came across any such questions. So do remember that I do not have to waste my double taxation relief. Q Limited. Q Limited will be incorporated, register for VAT and commence trading on 1st July 2021. It will trade in the UK and will be a UK resident company. That's fine. From a commercial standpoint, my intention was to own Q Limited personally. However, is there is sufficient tax advantage, I will consider establishing the company as a wholly owned subsidiary of P Limited. The first 2 years of budgeted results of Q Limited are set out below. The trading profit loss figures before the deduction of capital allowances, but have otherwise been adjusted for the purposes of corporation tax, which means that only the capital allowances have not been deducted from these trading losses or profits that are mentioned below. The chargeable gain will not qualify for rollover relief. I guess the player is talking about this chargeable gain. That's fine. So if everything is adjusted in these profits and loss except for capital allowances, it means all I have to do is I have to perform the working of capital allowances. So we will quickly revise capital allowances after reading the question. Okay guys, so what are the following assets we have bought? We have bought machinery and equipment, which will obviously qualify for WDA 18%. Building used for manufacturing and storage. Now guys, for that I'll be needing bit more details, because there is a new capital allowance that has been introduced in the Finance Act 20, and that is structures and buildings allowance. So can all of you raise your hands who know about structures and building allowance? How many of you are aware of structures and building allowance? Okay, not many. Especially for the students who have passed taxation before March 2021, this wasn't the part of the syllabus because they weren't announced. They are newly announced by the UK government and are part of Finance Act 20 only. So they will be applicable from now onwards. So we will study that what structure and building allowance is. The cost of the building includes 60,000 for land. So it means that Claire is providing me breakup of this 1.4 million. This 1.4 million includes 60,000 for land. Land is a non-depreciable asset, so obviously it will not qualify for capital allowances as well. 300 for the construction, and 1040,000, that is 1.04 million in respect of thermal insulation and air conditioning cooling equipment in order to create the appropriate conditions. So guys, these are the thermal and insulation and air cooling equipment. They are assets, they are not the building itself, and these are the assets that qualify for the special rate pool. How I have identified that? Guys, do remember, if there is an asset which is movable, it is a plant and machinery that is movable, or even if it is a heavy movable plant and machinery, but it is not integrated into part of building. What do I mean by integrated? There are few assets which you need to install while the construction is being carried out. For example, if I have to install electricity wiring in the building, I cannot, do it after every year or after every 3 years. It's done once the building is being constructed. So is the case with elevators, escalators, insulations, and assets like that. So if the asset is of such nature that it is integrated or installed into the land and building, such type of assets are the assets which have a very long useful life. That is why HMRC give them lower rate of depreciation or a capital nouns, and they will always be part of special rate pool. And the difference between the main pool and the special rate pool is that the assets that are in main pool will be depreciated by a 18%, or sorry, 16% every year, 18% every year. However, 6% will be available to the special rate pool assets. Now, so out of this 1.4 million, I know that only 300,000 will qualify for structures and building allowance, and I will quickly go through with you guys about that allowance. And 1.04 million will qualify for SRP special rate pool, and this 160 can go into main pool. So let's visit the capital allowance section of the notes. Meanwhile, if you have any question, please put it into the question section. So there you can find in the capital allowance section the structures and building allowance. So guys, obviously the buildings are of such nature that they have a quite long useful life. So HMRC has anticipated that at least the building has 33.5 year life, and they have provided straight line depreciation or straight line allowance of 3% over the life of 33.5 years. So if you multiply by 3 by 33.5 years, obviously in 33.5 years, you will get the 100% depreciation. Buildings can survive even way more than that. So even if your building survives for 50, 60, 70 years, you'll get the 100% depreciation in 33.5 years. Now, this is only available if the building has been constructed after this date. Why? Because the rule has been announced on this date. All of the buildings that have been constructed before this date cannot qualify for this. And I have told you that the allowance or the depreciation will be 3% straight line, which means that you only have to calculate the value once. The same answer will gets repeated every year. That is the ease in calculating straight line method. However, for any reducing balance method type of depreciation, you have to calculate the net book value every year. Why? Because the percentage applies on net book value every year. However, in straight line, the percentage applies on cost, and cost doesn't change. The net book value tends to change every year. Now, if you have bought the asset during the year, obviously you have to time apportion this 3%. Okay. And if you have bought the building in which there are assets installed, plant and machinery installed, that plant and machinery and asset cannot qualify for SBA. You have to separate the cost of total building and divide it into two parts. One should be the cost of the structure only, and one should be the cost of assets installed in that. The assets will qualify for either special rate pool or main pool. However, the building cost or the structure cost only will qualify for structures and buildings allowance. So that is what I have mentioned while reading the question. Guys, it was mentioned above that both companies prepare the accounts for 30th June 2020, and once completed, the building will be brought into use from 1st January 2022. So even if the building was bought at the very start, the rule states that you can only claim structures and building allowance from the date the building becomes usable. So the building becomes usable from 1st January 2022, and their year end is 30th June 2022. So they can only claim 3% times 6 by 12 for the first year. However, from now onwards, they can claim the complete 3% of the cost, that is 300,000. So do remember that. So guys, is there any question, or shall we move on to the solution? We will be using spreadsheet as it includes a lot of calculation, and in between we can provide the explanations. If there is any question, please put it into the question section. For now, I am moving on to the answer. So let's open spreadsheet and start answering the question. Now, I will open the extract here to see that what are the three stages in which I have to answer part A. Explain with supporting calculation the maximum type of loss relief, and I cannot tell what is the amount of maximum loss relief without calculating the loss in part 2. And then the conclusion I have already made. So let's start both parts together, because I have to calculate the loss in order to tell that what is the maximum amount of loss that can be surrendered. So this will be our part A1. Now here let's dedicate this wider column for explanations and this column for numbers. So first of all, I have to take taxable profits of Plard Limited. I guess these were mentioned in the question. Let's quickly look. These are 55,000. Now, less group relief, but I haven't calculated it. Whatever my answer is, that is this plus this will be my profits on which I have to charge tax, and then CT will be at the rate of 19%. So I can apply a formula here. Later on, the figures will change itself when I will put the loss above. Less I have to deduct DTR. Now, it said that the profits in Check-in Limited were subject to 14% tax. Let me quickly go to the scenario. Yes, the profits are 7,000 and there was 14% tax. So obviously the DTR is lower of the tax that has been suffered in UK versus the overseas tax. So you can clearly see that overseas tax is lower, 14%, and UK tax is higher, that is 19%. So this will be deducted. So 14,000, sorry, 7,000 multiply by 14%, whatever that is. I will apply formula here. It's 980. So CT liability will be this amount minus this amount. In the absence of group relief, whenever I'll post group relief here, the answer will automatically be updated. For example, I know the correct answer, so I can put the correct answer here, that is 44230. Let's say it will automatically update itself. Okay, so that is what I'm trying to tell you as to how this works. Now let's move to part B and calculate our losses there. For Q Limited, we will write Q Limited here to tell the examiner that we have now started working for Q Limited. And for Q Limited, we have to work for both years. And for P Limited, we have to work for both years as well. So what I will do is, I will start from here. And there are 2 years, that is 2021 and 2022, for which we have to perform the calculations. Now, first of all, profit slash loss. And guys, do remember what my trick is. I usually try to collect the data from the question first, the figures that are already given in the question, and then perform my own calculations. Okay, now let's go into the scenario first and see that what is the data we have available. They have made the loss of 10,500 in the first year. So I will go there and write it as a loss. Negative 10,500. Then we have to less capital ounces, which will further increase the loss. But I haven't calculated capital ounces, so I can say that please check my working one for capital ounces. I haven't calculated them. Then whatever it will be, will my trading profit or loss, which will obviously be loss, as we know that. Now let's see what are the figures available for 2022. For 2022, the company immediately turns into profitable company. The profit will be 971,000 and the company will earn chargeable gain of 16,000. So the profit will be 971,000. Capital ounces I haven't calculated, and the chargeable gain will add into profits, and it's, I guess, how much is it? 16,000. I can now put formulas here that what will be the total taxable profit, but I first have to, whatever my profits is, I have to deduct the losses. So let's quickly calculate the capital ounces first, because I then have the losses, and when I'll have the losses I can complete the part A. So all of this is interrelated actually. So let's calculate losses now. Oh, sorry, capital ounces now. Now, eh, we have to make main pool. There'll be SRP, stands for special rate pool, and then the final column will be for allowances. I will bold these as the headings. Let's select all of these cell and select their formatting. The formatting is not necessary actually, and the examiner will not gonna deduct marks unless it's question number one. And in question number one, obviously there are 4 professional marks, so you should try to make your answer look as professional as it can be. But do remember, you sometimes have to trade off. For example, if you know the answer but you do not have the time to present it in this very what you say, in a mannered way, so I will rather sacrifice 2 marks of the layout and try to answer the question and take the number of the adjustments. So you have to trade this off. If you do not have the sufficient knowledge and you want to take the numbers of the layout completely, then you should focus on that. So first I have to write that what are the additions that qualify for AIA. Let's move on to the question and see what are the assets that they have bought. This qualifies for AIA, and land is a non-depreciable asset. Building qualifies for SBA, and this also qualifies for AIA. So what I can do is I can go into this tab, sorry, spreadsheet, and write it here that the additions that do qualify are plant and machinery, that is for 160,000, and thermal insulation, that is for 1.04 million, I guess. Now these are the additions that qualify for AIA. However, the limit of AIA is only 1 million, so we'll less AIA from here. And guys, you tell me, what is the what is the most beneficial way to deduct the AIA? Shall I deduct it from SRP first or main pool? Answer me, SRP or main pool quickly. Okay, okay. More answers, please. SRP. All of you who are saying SRP are correct. Why? Because SRP assets will get the lower depreciation. So I will be wanting quick depreciation by giving them the AIA. However, main pool assets will be depreciated much more quickly because they will gonna get 18% depreciation, whereas SRP assets will only gonna get 6% depreciation. So it's always better to give AIA to assets that depreciates slowly. So I will write less 1 million here and 1 million as a positive here in the allowances column. So what is the balance that is left? and here complete 160 is left. Now I can now charge WDA at the rate of 18% slash 6%. So it is easy, just apply the formula that this times 18%, and you can just copy the formula but change the percentages above to 6%. Now I can then apply the formula this minus this here and copy it here to create the carrying values, carry forward values. Now because I know that, and these are the allowances, I can put formula here as well, that this plus this, and here I can again put the formula this plus this. These are my allowances. Now I can go here and again link it, so if I will make any mistake later on and I correct it, it can adjust my complete answer. And I can put a negative sign because I have to deduct the capital allowances. Now when I will add this, what it will gonna do, it will gonna add it both. Oh, if rather I should add them. Yes, so this will be my total loss before the capital allowances. Now, as I have to calculate capital allowances for both years, and there is one thing that I have missed. Can anybody tell me in the question what is the thing that I have missed? Come on, guys, I need answers. What about this SBA, structures and building allowance? We haven't taken that. Yes, SBA. And do remember, we cannot take it for complete year. Rather, we have to take it for 6 months this year, partially this year. So I can, do a separate working here for SBA. So SBA this year will be, the buildings were 300,000 times 3% times 6 by 12. 4,500 it is. So the total allowances will be this plus, sorry, this plus this. And here I have to press. So this will be my loss. Now, as I have to calculate the capital allowances for second years, but it is very easy. Why? Because there is no change that is mentioned in the question for second year. Let's quickly have a quick look. And yes, there is no change. Only these are the asset. And all I have to do is I have to apply the formula in that these are my carrying values, which will which will be my opening balances for the next year. And I can simply copy this. So this times 18%. I will copy this formula and change the percentage to 6, and I will copy this as well. It will add these two figures. So the next year, these are the normal allowances. And what about SBA? This is for 2021. SBA for 2022 will be 300,000 times 3% simply. Why? Because the next year I can claim the complete allowance, that is 9,000. So for next year, this is my one figure and this is my second figure for the year totals. So this year, the total of the allowances is SBA plus this figure. These are my allowances, and I can copy the same formula here as well. Now guys, as I now have the amount of loss that is available this year, I can now tell that what is the amount of loss that maximum can be carried forward. Are you guys with me till now? Any questions you can ask in the handout section. Sorry, in the question section. Why I have used 6 months SBA allowance, Baita asked this. But let me take you back to the question. It has clearly stated that the building, once completed, the building will be brought into use from 1st January 2022. The end of the company is 30th June 2022. It means that the building has only been used for 6 months this year, and the allowance will therefore not be available for the complete year. Rather, it will be available for 6 months. I hope I have answered your question. If there is any other question, please put it into the question section. Now guys, as I now have the loss available, I can now solve part A as well, that what is the maximum amount of loss that I need to set off. First, this loss will be given to will be surrendered to Plant Limited. Once Plant Limited is done, the company can then carry forward the losses to its own future profits. So now one thing you have to remember is that I have to save the profits equivalent to 980. So I have to check that how much profits can I leave, on which when I apply 19% corporation tax, it will answer or becomes equal to exactly 980. Why I want to do this? Because the Claire has requested me not to leave or not to waste this 980 benefits of it. So I have way more losses than 55,000, but I cannot deduct complete 55,000 losses. Otherwise my 980 advantage will gone. So very easy trick for that is how much profits you want to leave or how much tax you want to leave exactly. It's 980. So now you have to calculate that what should be the profits that should left, on which when you apply 19%, the answer should come 980. So consider this as 19%, okay, and multiply it by 100%. 5158, let's say, to round off. If I have 5158 profits left and I multiply it by 19%, 5158 multiplied by 19%, it's exactly 980 profits, equivalent to which I will not be able to waste my DTR relief. Now, so I have to leave profits of 5152. So out of 55,000, if I leave 5152, how much loss can I get relieved? It's 49848. 49848. This is the amount of loss that I can leave behind, so that exactly my answer will be 980. So guys, if I deduct 49848 here, you can see that it's exactly the 0 or -1. -1 is just because of the rounding of difference. So guys, let me explain it again, that what I have done here, why I have deducted 49848 losses. Otherwise I could have deducted the complete 55,000, because I have so many high losses. I have losses of 1046 200. Why I have only deducted 49848 worth of losses? It is clearly mentioned in the requirements that Check-in tax would be wasted and its UK corporation tax would be nil. That is what Claire wants me, that do not waste his DTR. I have left the DTR of 980 behind. So when the 980 DTR gets deducted, its CT liability will be 0. So I hope everybody understand this. If anybody is unable to understand, please answer. Please put your question in the question section. Now, moving on, what will be the total profits for Q Limited? Let's complete Q Limited's working. It will be this plus this, but obviously it does not have any chargeable gains, so its answer remains same. If I copy the same formula, its profit will be this. Now, for both companies, it has requested me to calculate the losses for both periods, right? And calculate the tax liabilities for both periods. So I have calculated for 1 year for both Q Limited and for P Limited. For P Limited, it's nil. For Q Limited, obviously the CT liability is nil because I do not have any profits to pay corporation tax liabilities on. Now, let's solve for P Limited for the next year. P Limited is assumed to have same profits as per the question, that is 55,000. I then have to deduct the group relief, and then remaining profits will be taxed at 19%. But before that, the maximum relief should be given to its own taxable trading profits. Now, guys, you have to understand this point carefully. Whenever a company suffers a loss in the present year, what they can do is, if they have any profits available of themselves, they should set off against that. If they do not have any of their own profits, they can then surrender it to some group member, which the Q has done. Q didn't had any profit, so it straight away surrendered it to P Limited. However, in the next year, it has carry forward losses and it has the profits available as well. So you have to make a loss memo as well. Loss memo is basically the calculation of how much loss has been utilized and how much loss has been left. So the total loss was this 1046,200. This was the total loss. This was the total loss. Less surrendered to P in 2021 was, it's 49848 or 49842. I guess I've might have made any small mistake, so I will write it out with the positive sign, 49842. Okay, this is the loss that I have already surrendered. Now next year I have some carry forward losses, and I can deduct this complete amount minus 952,128, so its tax liability can become nil. However, I still have some losses left. Nine five two one two eight have been surrendered against future profits. So this have been utilized by surrendering here. This amount has been carried forward against its own profit. How much losses are left? Let's quickly check. 44230 is the amount of losses that has been left. Remaining losses. Remaining losses. So what to do with these losses? In the next year, it can surrender this amount of loss to P again. So I will copy this. I will paste this here. The taxable profits will remain 55,000 next year as well, and we can give heading that's it's 2021 and it's 2022. This year the losses figure is 44230, as these are the only losses, and they have now surrendered to P as well to 2022, and now there are zero losses remaining. So this is the CT liability of first year, that is nil. That is the CT liability of next year, that is 1066 for P Limited. For Q Limited, the CT liability will be nil for both years, as it has very high amount of losses which have consumed its not only its own profit but a bigger chunk of P's profit as well. Now, if I go back to the extraction, I have discussed as to how we can utilize the profit without hampering this double taxation relief. I have then prepared the calculations for both years, and then I have concluded in advance while talking to you as to what will be the advantages of Mr. C or Claire owning the companies through the company itself, means P should own Q rather than he owning themselves separately. That they can form 75% loss relief group. So guys, it was a bit tricky question. I know there were a lot of concepts that might get confused. So the best advantage you can take is it is a recorded lecture. You can open the answers in front of you later on, open the recording in front of you, slowly play it, stop, try to understand what I'm trying to explain. Again, you can rewind forward it, but you can take the most out of it if you are unable to understand it in the first go. So guys, I think we should take a break here. So let's take a 10 minutes break, and then we'll come back and we'll start our next question. Meanwhile, post your questions here and I will answer them after the break. Okay, students, so we are back, and there were a few questions regarding this figure 515208. So yes, I have this figure I have mistakenly typed as 848 rather than 842. So that is why there was -1 answer. Now you can clearly see it's 0. Now, moving on to our next question, guys. It's Dent Limited and it's for March June 2019. It is very much a recent attempt question. So that is our next question. It can easily be found in the Kaplan exam kit as well as it can be found on ACCA Practice Exam 3 on Practice to Pass platform. So let's move on to the next question. As you can see, it's a 20-mark question, so obviously it will not have the requirement in three parts. Rather, in the requirement, you will find the requirements in an elaborative way. Whereas I have just did a 25-mark question with you that normally with 25-mark question, you have to struggle with understanding the requirement because requirement is not usually easily given into one piece. So now let's read the requirement, but before that, let's read the introduction of the question. Dent Limited requires advice on registering for VAT, the corporation tax treatment of its expenditure on research and development activities, and after-tax cost of the remuneration provided to the key employee. So these are the three matters. Obviously, the question will gonna have three requirements requiring these three matters. Guys, I have intentionally selected both questions that has more weightage toward corporation tax because the questions that I have selected for the first 2 days have the lesser chunk of corporation tax. So that is why I have dedicated third day to corporation tax. Now, let's read the requirement first. And before I start reading the requirement, just to confirm there is no audio and visual issue, can you raise your hand if you can see my screen and hear my voice clearly? Thank you. Thank you. So, starting with first requirement, advise Dent Limited on the implications for recovery of input value added tax for registering for VAT with effective from 1st April 2022, when it will be compulsory to do so, and explain why it is beneficial for the company to instead register voluntarily with effect from 1st July 2021. Guys, so I can see that there is a date in the a requirement that is in 2022, April 2022, when it will be necessary for us to register. However, we have to tell them that what will be the benefit from registering earlier. So there must be some benefit. That is a hint from the requirement. All we have to do is to read the requirement and to figure out what is the benefit. Then the part relates to recovery of input VAT before the registration. So this is a topic called pre-registration input VAT. You can find it in my notes in the VAT section. The topic is pre-registration input VAT. So what happens in pre-registration input VAT? If you have incurred or suffered input VAT onto some items, they can be goods, they can be services, but at that time you were not VAT registered. But later on some date, you get VAT registered. Is it possible for you to recover the input VAT that you suffered while you were non-registered? So it depends on whether it was goods or services. If they were goods or stock, then the criteria is you can recover their input VAT even if you bought them 4 years before registration, but they should be in your stock. at the time of registration. If you have bought them and sold them before the registration as well, you cannot recover their input VAT. So you can recover, however, they should be in your stock at the time of registration. And even if they have bought 4 years before, you can claim their input VAT on the first day of registration. Secondly, if these are services, obviously the services are intangible in nature, so they cannot be in stock at the time of registration. So if the services has been consumed and you have suffered input VAT on them, if they were within 6 months before the registration, the input VAT on them can be reclaimed, otherwise not. So for them, having in stock is not the condition. Now, we should keep this in mind while reading the question, that this is the criteria. And on the basis of that, we will suggest them whether it is beneficial for Dent Limited to register later on, or will it be beneficial for it to register earlier on. Now, coming back to the question, part B. As it says advise, do remember that it will not be including any calculations, and it is clearly mentioned that the calculations are not required. In part B, explain the corporation tax treatment of the R&D expenditure of 353,000 to be incurred by Dent Limited in the year ending 30th June 2022, and on the assumption that Dent Limited registers voluntarily for VAT with effective to 1st July 2021, that is the earlier date, calculate the amount of the deduction which will be available in respect of R&D for corporation tax purposes. Now guys, you can find this topic into my notes in the corporation tax chapter called the R&D relief. What you have to configure or to figure out first in the question is whether the company is a small and medium enterprise, SME, as far as the relief is concerned, or will it be considered as a large company. There is no criteria and you do not have to learn it. It will always be mentioned in the question that whether you have to consider it a large company or an SME. If it is an SME, all of the qualifying expenditure will get extra 130% deduction. For example, if I have spent 1000 on R&D, I can deduct that 1000, but I can deduct extra 1300 as well. So I can in total deduct 2300, because 1000 was allowed anyways, but there is 130% extra, that is 1300 more is allowed. So in total it is 2300 or 230%. The definition of qualifying expenditure is that any expense that has been solely and wholly and exclusively incurred for the research and development. If the expense is incurred exclusively for that, it is allowed for that extra deduction, except if you have subcontracted any of the service to any of the subcontractors. If you have, it will be applicable for R&D expenditure relief. However, only the 65% of the payment can apply for relief, which means 35% of the payment will be disallowed. So if the total payments in of R&D includes any subcontractorship as well, what you should do is you should separate that payment first, then only add 65% of that payment into the amount, and then multiply it by 130%. So we will be doing the calculations later on. And if it is a large company, the treatment is slightly different. And then you first have to add 13% as an expense, but then the same amount can be deducted as a tax credit from your tax liability. That you can read from my notes. Now let's read the scenario. Before that, let's read the last requirement as well. State the tax implications of the receipt of lump sum payment for Alina, and calculate the after-tax cost for Dent Limited in respect of the lump sum payment and provision of the computer and the temporary living accommodation to Alina. Guys, do remember that in requirement C, we have to calculate from the company's point of view. We have done several questions yesterday in which we have did the tax planning from the employee's point of view. So here we will not be doing it from employee's point of view, rather we will be doing it from the company's point of view. We will only state the implications only for the lump sum payment of a lena. Yesterday we have talked about inducement payment. I do not know at the moment whether it will be an inducement payment, but if this lump sum payment will be an inducement payment for a lena, then it will be taxable for her. And for us, being an employer, we have to pay an employer NI on that as well. Now, let's move on to the requirements. If you have any questions, please post it in the question section. Now, Dent Limited will be incorporated and start trading on 1st July 2021. Will undertake a research project to develop an innovative new process related to its trade. Will be a small enterprise for the purposes of R&D. So now it is clearly mentioned in the question that it will be a small enterprise as far as R&D is concerned. So we will be doing that 130% treatment, not that 11% treatment. Will prepare the first set of accounts to 30 2022. Will make wholly taxable supplies for VAT purposes. Now, Dent Limited budgeted income for the year ended 30th June 2022. Till now, I didn't had an idea as far as the first part is concerned that whether they should register for VAT earlier or later. The value of the trading receipts in the first few months will be low, such that Dent Limited will not be required to compulsorily register for VAT until 1st April 2022. That's fine. However, later on, Dent is expecting to receive substantial fees in April to June 2022, such that it's anticipating generating an overall taxable trading profit for the year ending 30th June 2022. All of the Dent's customer will be registered for VAT. Now, guys, this is very important line, and I would like to stop here and explain a very important point to you. If you are deciding whether you should register as a company or as an individual for VAT or not, one very important consideration should be whether your customers are VAT registered or not. Why? Because if your customers are VAT registered, for them it does not matter whether you charge them VAT or not. Because if you charge them, they will claim it as a input VAT from HMRC. If you don't charge them, it's still okay for them. So for them it does not make any difference. However, if your customers are end consumers and they are not VAT registered, it makes a lot of difference. Why? Because they will not be able to reclaim this VAT. For them it is very important that you don't charge them the VAT. Why? Because for them it will suddenly increase their cost by 20%. So let us consider that if the government in the UK is currently imposing a 20% value added tax on laptops, all of us, if we visit a shop, have to buy laptop. If I have to buy laptop, we have to, let's say, if the laptop is for £1,000, we have to pay £1,200. However, if the government suddenly removes the VAT on laptops, the laptop will all of a sudden becomes 20% cheaper for the end consumer. So guys, for end consumer, the VAT is very much the important, and for the company, obviously, if its cost will be high from its competitors, obviously its customers will move on to its competitors and the company will lose customers and so the profitability as well. So this line is very important that Dent Limited's customers are VAT registered, which means it is easy for Dent to register for VAT whenever they want to because their customers are VAT registered anyways. Now, before I move on to, because this was such important point, I would like everyone to raise their hands if they have understood what I have said. Thank you. Thank you. Now, moving on, now I can suggest them that if the company will start registering voluntarily for VAT as soon as they start the business, it will help them to recover all of the input VAT incurred or suffered on services and as well as goods. However, they still be able to recover the VAT even if they not register voluntarily and they register compulsorily later on. But for that, there will be a criteria which I just mentioned, that for goods, it is 4 years prior the date of registration, but they should be in stock. And for services, it is 6 months. So I will suggest, because their customers are VAT registered, they should not wait, and they should wait, and they should register immediately, as it their customers are indifferent whether they register for VAT or not. But for Dent, it will be beneficial. That is the answer of the first part. Now, let's discuss about the second part that deals with R&D expenditure. Dent Limited budgeted R&D expenditure for the year ending 30th June 2022. Specialist equipment, property costs, consumables, staff costs. Guys, I have to make sure that all of this 350,000 should be incurred for the research exclusively. All of these figures are exclusive of VAT where applicable. The property costs entirely comprise heat, light, and water expenses. That's fine. The staff cost included 25,000 to agency, which is VAT registered, for the provision for an unconnected external contractors services for the year. Now, guys, here you can see that I have subcontracted 25,000 out of the staff cost. So this 25,000 needs to be deducted first, and then 65% of that will be added back into the amount, and then we can take the 130%. The remainder of the staff cost wholly relates to the amounts payable to or on behalf of Dent's employee, including the pension contributions of 14,000. That's fine. The property costs, consumables, and agency fees are incurred evenly throughout the year. That's fine. So, guys, I would like to ask question here. Is there anything that does not qualify for uh, R&D expenditure? Like apart from agency cost that I have covered already. Is there anything else out of this? Can you answer me in the question section, please? Is there anything out of the above list that does not qualify? Biter, the heat, light, and water are incurred for the R&D, so property cost is the wrong answer. Property cost will qualify. Why? Because they have uh, not bought any property, rather they are talking about revenue expenditures that have been incurred. So that is qualified. Any other thing? No, pension contributions are for employees that have been exclusively hired for the project. So Iman, your answer is wrong. Guys, the specialist equipment is a type of asset. It cannot qualify for the enhanced relief. It will qualify for the capital allowances. That is why anything that is capital in nature cannot qualify for the enhanced relief. Only the revenue expenditures can qualify for the enhanced relief. Why? Because capital expenditures are subject to capital allowances. So for specialist equipment, you will gonna get AIA 100%, but they cannot qualify for enhanced relief. Do remember that. This was a very important point for which I have stopped here. That do remember that none of the capital expenditure can qualify for enhanced relief. Only the revenue expenditures can. So the property cost and all other cost can qualify, but the specialist equipment cannot. I hope I have made myself clear. So now let's quickly calculate that what will be the enhanced relief. The total amount is 353,000. 353,000 is the total amount. I have to deduct 110,000 out of that as a specialist equipment. So I'm left with 243. but I also have to deduct 25,000 as well. Why? Because it has been made to a subcontractor, and I will then add it back the 65% of 25,000. So let's deduct 25,000 as well. Do remember the amount was 218,000. So let's take 60%, 65% of 25,000 plus it with 218,000. So it's 234,250 total amount that does qualify for the enhanced relief. Let's take 30% of that. It's 304,525. So 304,525 plus 353 that will normally be allowed to deduct. Out of that, 100,000, 110 will qualify for capital allowances, and the remaining can be deducted from corporation taxes like normal expenses. So the total can be 657,525 that can be deducted. Do remember, it's your choice to add the 353,000 in the end or not, or you can clearly mention that 353,000 will be deducted as a normal expense. However, for enhanced relief, the answer will be 304,525 if you consider that as an easy approach. So both approaches are acceptable. Now, anybody has any questions, they can post in the question section. Now let's move on to the last part of the question, in which I have to tell about Elena's lump sum payment and company's cost for providing several benefits to Elena. Elena will commence employment with Dent Limited on 1st July 2021 to lead the R&D project. Okay. Alina's salary of 80,000 is included in the budgeted staff cost figure above. That's fine. On 1st July 2021, Dent Limited will additionally provide Alina with the following, none of which are included in the budgeted staff cost figure above. Okay. A lump sum payment of 10,000 in recognition of her forthcoming employment. It means, guys, they are welcoming him and paying him 10,000. So what do you think, that is it an inducement payment? Is it a golden halo? We have discussed about it yesterday as well. And should it be taxable for Alina? Yes, it is 100% taxable for Alina, and it will be added into her salary as an income. Yes. So that was the answer for the income tax implication of lump sum payment for Alina. That's it. Now we will be focusing on the company's perspective, for which the requirement has asked us to explain. So moving on, a new computer costing 1,000, of which Alina will have use, including significant private use for the first 9 months of her employment. So obviously, if we would have to talk the Alina's perspective, it would have been added into the Alina's employment income as a taxable benefit in kind, and the rule that will be applicable on that is use of an asset. And for use of an asset, 20% of the benefit would have been added into the Alina's employment income. But as we are talking from only the company's perspective, every non-cash benefit that the company provides, or any taxable benefit that the company provides to an employee, the company has to pay class 1A NI on that. Okay, so it is one of the non-cash or taxable benefits. So the company has to pay class 1A NI on the taxable value of the benefit. So the taxable value of the benefit for both Alina and Dent Limited is 1,000 times 20%, 200. This will be added into Alina's employment income, but we are not here to discuss Alina's point of view. The company needs to pay class 13.8 insurance on that. That is 27.6 pounds roughly. Now, moving on, But do remember, guys, one more thing, that for the first 9 months of our employment, which means that the benefits needs to be time apportioned as well. So what we're gonna do is we'll first take 1000 and take the 20% of that. It's 200. We'll then multiply it by 9 and divided it by 12. So the taxable benefit will rather be 150 than 200. And on that, the company needs to pay class 1 NI. But we will keep this benefit for the time being and we'll add all other benefits in that and then take 13.8 of the total. Now, company is paying the rental cost. Living accommodation, guys, is a taxable benefit in kind as well. And in that, we only check whether the accommodation that is being provided is owned by the employer or is it a rented accommodation. If it is a rented accommodation, we have to take the higher of two values: rent paid by the employer or the annual value of the house. Now, Dent Dent will rent a flat for Alina that it will rent from July to December. So I guess that is for 6 months. Dent will pay the rental cost of 660 per month, and the market value of the house is 225. The market value is not required here. Why? Because it is rented accommodation, and the annual value is 2800. So guys, we have to see what is higher of, annual value or the rent paid by the employer. But annual value is for 12 months, so we have to lower down the annual value by dividing it by 2 because we need for 6 months. One value is 1400, the other should be rent paid by the employee. Rent is 660 times 6, 3960. You tell me which one is higher, 3960 or 1400? Which should be taken, guys? Rent paid by the employee? Yes, thank you. The rent will be taken as a taxable benefit in kind. So we have that rent available plus 150 as the benefit of laptop. So the total benefits that the company is providing to Alina till now are 4110. Let's check that is there any other benefit. No, there is not. So first of all, the company has to pay 13.8 class 1 NI, that is around 567 pounds the company has to pay. On top of that, the company has actually have to spend 1000 to buy the laptop plus 3960 is the actual rent that the company will be bearing, and plus 567 as a class 1 NI. So 5257 is the complete expenditure that the company has to suffer for the benefits and the class 1 NI. Now this 5257 can completely be deducted as an expense and will provide 19% corporation tax saving to the company. Apart from that, there was another thing mentioned in the question that they were providing to Alina, and that was lump sum payment of 10,000. But there is 13.8% NI on that. So 1380 NI plus 10,000 actual payment, 11,380. So 11,380 as the total of NI and payment that is being paid by the company as a lump sum to Alina, and we have calculated the benefit as well. So what I'll do is I will now solve it on a spreadsheet so that it will gather or consolidate all of the things that we are discussing. So we'll start with lump sum payment first because it's easy to solve. So the payment was 10,000 and class 1 NIC at 13.8% was this times 13.8%. Now the total will be this plus this, total cost. Now let's talk about benefits. The benefits we know, the first is computer that the company is going to buy for 1000. Then it's the rent, which is 660 per month times 6. I will apply the formula here, 3960. And then the last was the NIC on both, class 1 NIC on both at the rate of 13.8%. Now, as I have calculated already with you guys, so I will just post the answer here straight away. And total cost will be, we'll apply some formula. Total cost will be 5257. So now, lump sum payment and this payment. There you can see the clearly what is the total cost that the company is going to pay. And now let's quickly check that what will be the CT savings. So the cost will be this plus this less CT savings. Now CT savings will be on the total benefits that the company is providing. That is this benefit of 11,380 here plus, or what we can do is it's easier to straight away take the tax savings from there. These cost times 19%. So guys, these are the after tax cost that the company will have to suffer. Now, if this was in the absence of the additional R&D relief that could be applicable. The question has asked that what if the cost that the company is providing to Alina may qualify for R&D relief, then what? So if the company's cost can qualify as an R&D relief, then these benefits are not necessary to provide to Alina for the research and development. So that's for sure that these benefits cannot qualify for the extra relief. For extra relief, only those costs can qualify that are necessary. Yes, but do you believe, guys, that paying this 10th or 11,380 is necessary to hire Alina? Otherwise, we couldn't have hired her, and she's the project head. So, what do you think? Is this the relevant cost? The benefits, I believe, are unnecessary. But what do you believe? Answer me in yes or no. Do you believe that this cost is required to pay to Alina? Yes, guys, if we wouldn't have paid her inducement or golden hello, she wouldn't have, joined us. So only this cost can qualify for extra 130,000 relief or 130% relief. And what can that be? R&D relief equals to this times, we can directly take 230% rather than, adding 130%. That can be the extra benefit that the company could have obtained. And if this could have been the extra benefit, then the company could obviously would have obtained CT savings on that as well. So I, rather than C7, Let's take C8. And what was the figure in C8? This was the figure in C8. Let me zoom out my workings for you. This is the R&D cost that qualified. You can use this color thing as well if you want to highlight any specific thing to your examiner. These are the post-tax costs. So guys, I hope that I have explained this as easy as I can. If you have any question regarding this, please post in the question section. Let's take a short break of 5 minutes and I'll join you after the break and then we will move on to the third question of the day. So students, let's resume our session. And the last question for today, I have selected it from September 2018 attempt. The name of the question is D. It is also available on ACCA practice platform in the practice exam 1. As you can see the requirement, it is a 25 mark question. So again, I have selected another 25 mark question today. Normally the 25 mark questions are on corporation tax and VAT, but this cannot be necessarily the case in your exam. But majority of the times I've seen that the examiner would like to test the 25 mark question on corporation tax and VAT issues. So now, as you have seen in the previous question as well, that you have the schedule, which you can also call scenario. Then you have the email from the manager, in which you will find the requirements in an elaborative form, and then you have the requirements. And in this question, the requirements merely include the marking scheme. As you can see here, they just include the marking scheme. So requirement A is on minimizing income tax on investment income. Then B is gift to CAM, and then C is tax efficient investments. Now guys, if you ask me as a student, I will be more concerned in answering C first, then B, and in the end I will be focusing on A. But that is only from reading's perspective. When I have to write answer, I will try to start in the chronological order. Now let's read the question, and I know that this is a 25 mark question. If I score good marks in part B and C, I can easily score 14 marks, which are ample to pass this question. So let's read the email from manager, which will include the detailed requirements. So I will first read the shorter requirement first: tax efficient investments. A comparison of the income tax implications for D of investing 50,000 in either EIS shares or VCT shares as requested. Okay, now what I should do is, in my notes, you can find a topic in income tax called tax efficient schemes or tax efficient investments. Under that, you will find certain investments that are tax efficient. For example, ISAs, there's an individual saving account. The limit is 20,000 per person, and you can invest cash or shares in that. Any income from that account is exempt. Either it is in the form of interest on cash, or it is in the form of dividends. Then you have accrued income scheme. You can study it from there. Then you have EIS, enterprise investment scheme, that has been asked in the question. Guys, EIS scheme is a scheme for new companies. There are certain criteria that the company needs to achieve in order to participate in that scheme. But because the new companies have a high risk of getting default or not becoming successful, the investors are not encouraged to invest in that. So the government has came up with a solution that they have provided tax incentives, that if the investors will invest in these companies, what will happen? They will be provided with tax advantages. And what are the tax advantages? The first is, whatever amount you will invest in EIS shares, you will get a tax reducer of 30% of that amount. For example, if you have invested 100,000 in that, if you have invested 100,000 in EIS shares, you will get 30%, that is 30,000 as a tax reducer. What you can do with the tax reducer, you can deduct it from your final income tax liability. For example, if tax for the year is 45,000, you can deduct 30,000 from that and just only pay 15,000 to HMRC. Is there any limit? Yes. The maximum you can invest in 1 year is 1 million. So you can invest 3 million in 3 years, but you cannot invest more than 1 million in 1 year. So obviously the maximum reducer you can get in a year is 300,000. What if the reducer is even more than your tax liability? Obviously it will gonna result in refund. HMRC will not gonna refund you the money. Either what you can do is you can carry back your reducer for 1 year. If your previous year tax liability is not enough to tax cover up your reducer, it will gonna go in vain or it will be wasted. So it's beneficial to check your liabilities first and then decide as to how much you should invest, so your reducer will not go waste. Let's talk about VCTs, venture capitalist trust. The venture capitalist trusts are normally the big quoted companies listed on stock exchange, and their specialization is that they look for the companies who have a very good potential in them, but they are lacking funds. So they provide them the funds and they buy the business at a very low price. Why? Because the business is struggling. So the business is bound to sell certain portion of theirs to get funding. So for example, if my business is struggling, I may look for an investor who can buy 30% business from me, but pay something in return to me. With that funds, I can you know rebuild the business. So VCTs pay an amount of money to these startups and buy them at a very low price. Then they build them by providing them the money, the necessary expertise and stuff. And when the business becomes a grown business, they then sell it for a high amount and exit themselves from that. Now, these are the companies which people know that they have the expertise on investing, and there is a very low chance that the VCTs will not pay you either good dividends or profits. So they are considered to be the less risky options. So, but government has also, the HMRC has also incentivized investors to buy the VCT shares as well, and the incentive is exactly the same. That is, whatever you invest in VCT, you're gonna get 30% as a reducer. However, the limit is quite less as compared to what it is for EIS. The limit is 200,000 per annum. So obviously the maximum reducer you can get is around 60,000. Now, obviously, because you have invested in shares, the amount of return or the way of return you're gonna get is in the form of dividends. Now, if you are getting dividends from EIS, they will be taxable like normal dividends. However, if you are getting dividends from VCT, they will be exempt from income tax. So this is an added advantage to VCT, that you're gonna get the reducer as well, same as you are getting it on EIS, but on VCT you're gonna get the exemption from dividend as well. Now, moving on to the question, we have done with requirement C. Now let's quickly look to the other smaller requirement, that is requirement B, gift to CAM. I don't know at the moment who CAM is. By reference to CAM's domicile status, explain why D proposed gift of 150,000 to CAM would result in IH. It means that this part mainly belongs to IHT. For that, I have to check that who CAM is and how this potential liability might be avoided. You should note that D gave CAM a half interest in her home on 1st August 2017. Okay, the value of the gift was 600,000. So the Cam has already received a previous gift that was worth 600,000, and now the Cam is either deciding that he or she should give 150,000 to Cam as well. Okay, now calculations in order to show any capital gains tax saving which would be achieved if D were to give Cam a one-third interest in London House. So I have to check that what is the relationship between D and Cam. Why is he or she giving gifts to him? So then I'll be able to suggest as to what to do. But that I know for sure that this part relates to IHT. Now, the reason I am assuming that I don't know about the question, although I know, because I am assuming myself as a student who is reading this question for the very first time. To give you an idea what my thought process is when I am actually reading the question for the very first time, as to how I satisfy myself that whether I have the knowledge from which needs to be which is required to answer this question or not. Now, minimizing income tax on investment income, so that is the bigger part. When carrying out this work, you should assume the shares purchased will yield a 4% return per annum and the cash deposits will return 1% per annum. Okay, I don't know what the share purchase and deposits are for. I will look into it when reading the question. Whole of the 450 will be available to invest. Okay, D will pay any capital gains tax due in respect of the sale of the London house. Fine. None of the investments will consist of EIS or shares or VCT shares. Okay. Calculation of the income tax saving which would be achieved in a complete tax year if D were to follow her friend's advice of 150,000 of the proceeds from the sale of London house to Cam in accordance with the alternative investment plan. So I don't know who D's friend is and what is the alternative investment plan he gave him or her for 150,000. I have to check that. But I have to perform income tax savings for that plan. That's what I know by now. To do this efficiently, you should just calculate the additional tax payable by D and CAM on the income generated by inheritance funds rather than preparing the complete tax computation. So I'll not be preparing complete income tax computations, rather I'll be just calculating resultant savings. To save you some time, I have already calculated if D invest whole by herself, she would incur an additional income tax of bank interest and dividend of 4485. That's fine. So one answer is already there, 4485 if uh, D invest all of the money herself. However, if they both invest, I have to calculate the second option myself. That's fine. It seems to me that total income tax liability of D and CAM could be reduced further. Fine. List still retaining the fundamentals of D's alternative plan. D would still give CAM 150, but rather than each of them investing two-thirds of their funds and leaving the remainder to cash deposit. Okay. So the total investment of 300 in shares and 150 in cash deposit will split between them in a different way. That's fine. So first the 450 will gonna be split between them, 300 to one and 150 to one partner, and then they both will gonna invest in the shares and the cash deposit. That's what I understood by now. But it is pretty confusing. You should only consider the income tax position of D and CAM and the nature of proposed investment. I do not require you to produce calculations of any potential tax savings. That's fine. So for this part, I will not be calculating any tax savings. The matters to be considered in relation to the income tax in respect of the proposed gift of 20,000 to Oder. I don't know who Oder is. So let's read the question now, guys. You can see that you have many questions in mind while reading these requirements. You have a puzzle in your mind that is not getting solved, but this is how these questions are. You have to struggle a bit, but then while after reading the question, after reading the requirements, maybe for the second time, you will have the clear picture in mind. So please keep ample time in your mind for reading these questions. What happens is, normally what we do, we calculate that, okay, 25 times 1.8, we have 45 minutes. But you can see how confusing the scenario is. I may need 10 to 15 minutes just to read and to understand what the examiner is trying to, ask. I will then only have 30 minutes to answer. So you were like, sir, what should I do? Shall I quickly read the answer and spend more time in writing the answer rather than reading the question? Absolutely not. I will prefer you should rather spend more time in reading and get the complete picture. And then, if you'll have the idea what is being asked, you may be able to produce the answer in 30 to 35 minutes. But please spend ample amount of time on carefully reading the answer, because you may think that you don't know the answer, but if you read carefully, even if you haven't understood the question for the very first time, read it again, but spend good time on reading and understanding what is being asked, and only then answer. But if you are in a very unfortunate situation that after studying it for the second time you're unable to understand what is being asked, simply then go for the easy parts and try to answer easy parts first, and whatever then you can produce out of the difficult parts, produce that, try to earn maximum marks from there and move on. So I've told you about both strategies. So please raise your hands if you have understood what I've tried to taught you regarding tackling the question. Okay, thank you. Moving on, let's open the scenario. Okay, but before that, I would like to read the introduction first. Your manager has forwarded you to schedule to you from D, a new client of your firm. The schedule add an email from your manager detailing the work he requires you to do are set out in the exhibits. That's fine. The first is exhibit from D. So let's read what D is trying to say. I am a resident and domiciled in the UK. Okay, my husband Cam. Fine. So D and Cam are husband and wife. Cam is her husband. Moved to UK in January and we were married in June 2017. So I have now idea whatever she's trying to do, or gift or transfer, she is doing it with her husband. So I have to keep the tax implications with wife in my mind as far as the IHT is concerned and the income tax is concerned. Cam is resident in the UK but domiciled in the country of Riveria. I have a 16-year-old son, Oder, who is resident in the and domiciled in the UK. Okay, so Oder is her son and Cam is her husband. I have, now a little bit idea as to what the requirements were. I may have to look through the requirements again just to, clear the confusion in my mind. My father's London house. Okay, I guess that was the house that she was talking about selling and investing the proceeds from this house. My father died on 1st June 2021 and I inherited this house. The house had a value for probate purposes for 390 but is now worth 450. My father purchased the house for 130. It doesn't matter because she has inherited, so the cost doesn't matter. For her the cost will be 390 because she has inherited the house, not bought the house. So when you have inherited the house, you have actually bought it on the value. So for her the cost will be 390,000. Now the proceeds will be 450,000. I intend to sell the house as soon as possible. That's fine. Investment plan in respect of the proceeds of the from the sale of the London house. I plan to invest 450 proceeds as follows: 300,000 purchase of UK shares and 150,000 for cash deposit in the UK. That's fine. Whatever the shares she purchases, she's gonna receive dividend from there, and she has to pay income tax. On cash deposit, she's gonna receive an interest, and she has to pay income tax on that as well. Alternative investment plan. I guess this is the plan they were talking about, and this is the plan that their friend has suggested them. So that's fine. Now, under my friend, it has been suggested to me by a friend who is a tax advisor that I should consider an alternative investment plan which would result in a lower income tax liability for me and my family. That's fine. Under my friend's suggestion, I would give 150 of the sale proceeds from the London house to Cam, leaving me with 300. That's fine. We would then each invest two-thirds of our respective funds in shares with the remaining third left on cash deposit. That is fine. I would like to know what income tax savings would be if I followed my friend's advice rather than my original plan. Okay, so I have to calculate the tax savings. Gift to order. I am also considering making a cash gift to order 20,000 out of my existing funds. That is not from the proceeds of the sale of London house. Okay, fine. So the 450, the 20,000 gift will not be out of 450. Rather, she will be gifting it from her existing funds. Order would place the amount on cash deposit. Okay, that's fine. So order will they deposit this in cash deposit, and order will gonna earn the interest from that as well. Guys, here I would like to stop and tell you a very important rule. If you remember, it was mentioned in the question that the age of order is 16 years old. He is younger than 18 years old. Now what happens is, if any income that a child who is younger than 18 years old earn, and that income is above 100 pounds, that income will be considered as the income of parent rather than the child itself. However, if the income is 100 or less than 100, it will be exempt for the child and for the parent. So you have to remember that if the cash deposit, the interest from the cash deposit is more than 100 pounds, it will be considered as the income of D rather than the owner's income. This is a very important rule. Do remember that. Our annual income. I set out below our current annual income. The bank interest and dividends are in respect of cash deposits and shares of all which are held within ISAs. We invest maximum possible amount into ISAs on 1st May each year. Order has no income. None of us have made any previous chargeable gains. Okay, now this is their income, guys. Annual income for D 170,000, then bank interest, and then dividends. I guess the income of D is even higher than the higher rate band, more than 150,000. So she is probably the additional rate band pair. Whereas by looking at the cam, I can tell you that he is a basic rate band pair. Okay, that's fine. Might be that is why their friend who is a tax advisor is suggesting D not to invest all of the money herself, rather share some of the money to D, so the tax can be avoided or saved. Why? Because the income that D will be getting from the investment will be getting taxed at a lower rate as compared to sorry, the income that will be received by CAM will be taxed at lower rate than D. So I guess that is why they have suggested tax efficient investments. I guess this is the second part. I have considered investing in EIS shares but have not done so due to high level of risk involved. I have already told you guys what is the a high level of risk, because these are the new companies. However, I understand that the VCTs have a lower level of risk. Please let me have a comparison of the income tax implications of these two forms of investment on the assumption that I will invest 50,000 in the tax year 2021. I do not know for how long I want to hold these shares. Now, guys, this gives me a hint that I should then tell Cam that for how long she should hold shares if she wishes to invest in VCT or EIS. Now, guys, there is a catch in the release that I have just taught you. If you invest in EIS, you're gonna get the 30% tax reducer, but do remember that against that tax reducer, if you sell the shares within 5 years for VCT, HMRC will gonna ask you to return the reducer amount. Why? Because you have to hold the investment for 5 years in VCTs at least. Otherwise, you have to return the tax reducer which you have taken when you invested in that. Okay. Now, if you have invested on contrary in the EIS shares, you need to hold the shares for 3 years. So holding criteria for EIS is lesser as compared to VCTs because these are more riskier shares. So the only criteria is to hold them for 3 years. If you sell the shares before 3 years, you have to return the reducer to HMRC. So that is one point I will tell to D regarding the investment. The other point I will gonna tell her is the tax reducer. Because she's a client, a layman, she does not know anything. So I will tell her that as soon as you'll invest either in EIS or VCT, you're gonna get 30% as a tax reducer, which in your case, because you are thinking of investing 50,000, in your case, it will be 15,000. 15,000 you're gonna get as a tax reducer. That's one thing. During the duration in which you have kept the shares, you will gonna receive the dividend. If you have invested in EIS, the dividends will be taxable. If you have invested in VCT, the dividends will be exempt. So there is an added advantage in investing in VCTs. And then lastly, I will tell her the holding period which she needs to hold the shares to keep the reducer. So these are the 3 points I will tell, and I'll score in this part first, and the later parts I will try to figure out later on. So in requirements, I'll try to secure these 5 marks first, then the gift to Cam, and then maximizing income tax investment. Now, getting back to the question, let's quickly go through the requirements again to see that from which point I have to start. Okay, the first of all, I have to start from the shares that one will purchase will have 4% return per annum, and the cash deposit will gonna have 1% return per annum. So guys, let's quickly use the spreadsheet and do the calculations that what will one be earning and what is the tax savings that they can achieve. Now guys, do remember I have to compare it with an option that what if D could have invested all of the amount by herself, and the answer for that was mentioned in the question. So I will again take you to here. It is mentioned here that if she invests completely herself, the tax implication will be 4485. So I will start with this. Meanwhile, guys, if you have any question, please put it into the question section. Okay. So we'll start with tax savings. Obviously, as I told you before, my approach is first to put data that is given into the question. If D invests 100%, then the answer will be 4485, that is mentioned in the question. If both invests, I don't know the answer, I have to calculate. Now, D investment, now guys, the total funds that D has are 300,000. Why? Because the total amount is 450, and if we divided it in three parts, one third will be with CAM, less two-third remaining 300,000 will be with D. So the total investment of D is 300,000. Now she further has to invest out of this 3,000, one third she has to invest in shares, and I guess one third in cash and two-third in shares. So what will be the cash amount? Let's check. Cash, she will invest 300,000 times 1 by 3, whatever it is, into cash, and the return I guess was 1% on cash. So let's quickly see what is one third of 300,000. Obviously it will be 100,000, and if we multiply it by 1%, it's 1,000. So our answer will be 1,000, or what we can do is we can apply the formula here. 1,000. That is the investment on cash. Let's see what is the investment on shares. It will be obviously the remaining two-third investment, that is 200,000 I guess. And the investment on the shares yield was 4% if I remember correctly. Please correct me if I am wrong. So let's apply the formula here. It's 200,000 times 4%. It will be 8,000. That will be the return on the D's investment. Now let's copy the same for CAM. Her money is 150 and 150. You have seen how I save my time by, copying the text, because it is not possible in the exam to write the complete thing. So one third of 150 will obviously be 50,000. So it will be 500, and then remaining will be two-third will be 100,000. Now this is the total incomes of them. Now as far as the tax liability is concerned, because she's an additional rate band pair, all of her income will be taxed at 45% if it is saving and non-saving income, and dividends will be taxed at the highest rate of 38.1%. So let's make a column here of tax. This income will be taxed at 45%. However, this income will be taxed at 38.1%, but the dividend nil rate band will be available. So what I will do is this minus 2000, and I will put brackets, and whatever is remaining, multiply that by 38.1%, because I have to take the dividend nil rate band, and total tax will be this plus this. I will copy these figures here, but I have to change the formula. For Cam is a basic rate band pair, so her incomes of savings and non-savings will be taxed at 20%, and her dividends will be taxed at 7.5%. So this 500 could have been taxed at 20%, but the problem is that he has savings nil rate band available of 1000, being a basic rate band pair, and his incomes of savings are lesser than 1000, so this will be taxed at 0%, which means it will not be taxed. And these incomes of 4000 will be taxed at 7.5% because he's a basic rate band taxpayer. So his tax will be 150. Now, what will be the total tax of the couple? It will be this plus this, 2886. So what I can do is I can take this figure if both invest and resultant tax savings. One five double nine is the amount of tax savings if both invest rather than D investing 100% herself. So guys, before I move on to the theoretical part of this, please raise your hands if you have understood what I have tried to taught. Thank you. If you have any questions, please put into the question section. Uh, Baita, we just have to explain the treatment. Baita has asked that will we consider whether the dividends from EIS and VCT have different tax treatment? Obviously, yes, because he has asked us to consider the implications. But that has been asked for the last part only. This part in which they are investing in shares, it has clearly mentioned that these shares are neither EIS nor VCTs. These are normal shares of some other company. Thank you. That is why, guys, reading the question is very important. If we have to spend time, we will rather spend more time in reading the question than solving it. Why? Because you may miss some important points. Okay, now, so I have mentioned that. That is the first part. Let me go and check. I have done with this parts, and now let's check what has been asked in the third part. And I have done this part as well, which asks me that what are the matters to be considered if the gift is given to order. I've already explained, because order is less than 16 years old. If he will be given any tax, if he will be given any benefit or income, it will be considered as the income of the parent. So let's say if order invests 20,000 in cash deposits, and it is mentioned in the question that the cash deposits are giving 1% interest, he will be receiving 200 pounds interest, which is higher than 100 pound of the threshold. So it will be considered as D's income, not the orders. And because D is a higher, additional rate band pair, this 200 will be taxed at 45%. So I will not recommend D to provide this gift to order. And even if she wishes to provide, order should not invest it to cash deposit until he becomes 18 years old, so this can become his own income. rather than her mother is. Okay? So now moving on, at the very last point, oh sorry, the second last point is that it seems to me that the total income tax liability of D and CAM could be reduced further, less still remaining the fundamentals of D's alternative investment plan. D would still give 150, but rather than each of them investing two-thirds and leaving the remainder, they should split it in a different way. So what should be the different way, guys? His friend has suggested that the split should be like 300 with D and 150 with Cam. But if I ask you that you have the choice to suggest her something different, what will be your answer? What will you suggest? Quickly answer me in the question section. Do you have any other suggestion in mind? Whenever you have to perform this tax planning for couples, always look for their positions. For example, if I look at Cam's position, first of all, he's a basic rate band pair. He still has many, high amount of margin left. Even if he becomes a high rate band pair, still his income will be taxed at 40% rather than 45. Although he still has some basic rate band left. Number one. Number two, he also has 500 basic nil rate band left of income tax savings nil rate band. So that is another thing. So I guess it will be more feasible if Cam invest more and D invest less. Why? Because the tax rate of D is high because her income is already very high. However, D's income is comparatively low as compared to Cam. Okay, so I guess that is the alternative solution that I will be providing both of them. That they should change the ratio and they should allow Cam to invest more rather than D to invest. So I've done with part A, guys. We have done the part C already. So let's discuss part B now by reference to Cam's domicile status. Okay, so we see that D is planning to gift 150 to Cam and she has already gifted 600,000 to Cam already. But Cam is not a UK domiciled spouse. Do remember, if you are a UK domiciled spouse, you have an unlimited number of gifts option available to gift each other or to transfer each other, and it will not attract any IHT. If you are a UK domiciled spouse, if you're a non-UK domiciled spouse, the limit is equivalent to nil rate band, that is 325,000. It will not consume your nil rate band, but coincidentally the amount is same, 325,000. So for D, the maximum amount that CAM can give to D without attracting IHT is 325,000. If anything, D gifts to CAM above 325,000, it will be considered as a pet. And if D were to die within 7 years, CAM has to pay tax on that, IHT on that. That can go up to 40%. So, is there any option by which they can relieve this? There are two options. First, there is a topic in IHT which you can find in my notes called deemed domicile through election. HMRC provides options to non-UK domiciled spouses that they can voluntarily elect to HMRC and become tax resident for IHT purposes. And with this, they will be considered as a UK spouse, UK resident spouse, and the 325 barrier will be removed. Rather, they have the unlimited amount available to transfer to each other. That is the advantage or the good side of it. The bad side of it, if Cam has any property in Riviera of the country of which he is actually resident of, that will subject to UK's IHT as well. So that is the disadvantage. Before that, her Riviera property was not subject to UK IHT. But if he wants to become UK resident, He's gonna have the unlimited amount of transactions available from the exemptions of IHT, but her property in Riveria will subject to IHT. That is the problem. There is another option available which we have discussed yesterday, and this option is called deed of variation. Deed of variation means varying the will. They can modify the will of D's father, and rather than first D getting all of the proceeds of the house and then she transfers to her husband, she can modify the will of her father and she can directly transfer that one third to her husband by modifying the will. In this way, D will not get involved in any of this. Rather, Cam will directly get this 150. These are the two alternative options which the couple can utilize and reduce or minimize their IHT liability. So guys, I hope the questions that I have selected were around difficult topics. That is why I have selected those. Even if you were unable to understand any of this, please go through the recorded lectures. Try to play them slowly. You can play back, rewind, and listen to it again and again and understand what I'm trying to explain here. I hope this has helped you or at least taught you as to how to tackle these difficult questions in the ATX exam. You should break them in smaller parts. Try to answer the smaller parts, easy parts first as far as the reading is concerned, and then answer the difficult parts. If you have any questions, I can dedicate last 2-3 minutes to your questions. Please post it and I will try to answer them. Any questions, students? Baita, you have to watch my yesterday's lecture. I have gone through the deed of variation in detail. Okay, guys, with that, I would like to sign off. I would, uh, I hope that this session has helped you guys, and I hope to see you guys tomorrow as well. Do remember me in your prayers. Hope to see you tomorrow. Till then, take care. Bye bye.